Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look at a number of different things. First, I look at the valuation of the S&P 500 on a historical basis as well as a forward-looking basis. Then we do an extensive study of growth versus value. When we want to buy low and sell high, that's growth. When value is doing well, that tends to be more defensive for the market, even though value stocks can still go up when the rest of the market is going up. Typically, what money managers and mutual fund managers will do is they'll go over into value areas when they're thinking that the market is going to get set for a decline. So we want to keep an eye on that area. We also look at other markets outside of the stock market. We look at some commodities, we look at other indexes, and we do a lot of ratios between different indexes because sometimes we can get some insight as to what's happening in the market by looking at these different areas. This is being prepared for Monday, September 23rd. I do have a thing called the SPXInvesting Program. It's up, it's going. There's a link below this video that will take you to that website. There's also a link that'll take you to a video that talks more about the program. If you have any questions, here's an email address to contact me. The daily video is really the foundation of what I do as far as my analysis. What you're watching right now is the InterMarket Analysis video, and that's just one video that I do each week that ties into the daily video. Okay, the first area that we look at is S&P 500 valuation. This looks on a historical basis by looking back at past earnings and compares those earnings with the current price of the S&P, and we have static numbers that we use to try to determine, is the market expensive, fairly priced, or cheap? When we're above the red dashed line, that means the market is expensive on a historical basis. And you can see the black line is well above the red dashed line of a PE ratio of 20, because when it's 20 or above, the market is considered to be expensive. When we're between 19 and 11, the market is considered to be fairly valued. And if we ever drop down to 10 or below, that's the green dashed line, then the market is considered to be inexpensive or cheap. You can see by going all the way back to 1980 that we can spend a large amount of time above the red dashed line. We don't use this for timing. We just use this for information. And yes, the market is expensive right here and probably should pull back based on what has already happened as far as earnings, but the market doesn't do that. So if you use this as a timing mechanism, you're going to spend significant amount of time outside of the market and missing a lot of gains. Down on the bottom, it's just a measurement between the current value of the S&P and the PE ratio of 20, also showing that we're quite overvalued on a historical basis. This is the same thing going back to 1980, but different events that have happened along the way and what the valuations were at that time. Then a variation of this is something that was developed by Robert Shiller called the PE ratio, or PE 10. It's also the Shiller PE ratio. This is what you see here. You also may hear this referred to as CAPE, C-A-P-E. And what he has done with this is try to smooth out earnings over a period of time to take care of any outliers, really good quarters, really bad quarters, try to get more of an average of what a company's doing on an earnings basis. And right now, the Shiller PE ratio is coming in at 36.63. This goes all the way back into the 1800s to show you that, yeah, we're pretty overpriced right now. The last time we were higher than this was right about at the end of 2021. And we really spiked up back in the year 2000 when this happened. We're coming in at 36.63 right now. To get another gauge on where are we, the median and the mean over this period of time is anywhere a little bit above 17 and a little bit below 16. So even on a historical basis using this method, we're also considered to be overvalued. But the market doesn't do that. It looks forward. And what I have plotted here, this is a chart developed by Edward Giardini. He has in purple, these are the PE ratios for the mega cap 8. And they're pretty high right now, coming in at 26.4. And so they're overvalued, but folks don't mind spending more for that because these are companies that are really growing as far as earnings are concerned. The red line is the forward-looking PE ratio for the S&P, and we're currently coming in at 20.9. This is above that 20 level. So even looking into the future, we are considered to be overvalued at this point. Then we look at the mid caps and the large cap, or the mid caps and small caps down below. They're coming in right at about 15. So they're fairly priced. And from a valuation standpoint, if you're a fundamental type investor, they might start to look attractive to you. But then you need to look behind this to look at individual companies. Are they really making money? A lot of mid cap and small cap companies, they might be popular, but what's the earnings behind those companies? And so that's what can make these companies a lot more risky at times. Then we look at growth versus value. First, we look at a growth chart all by itself, and we're in an uptrend. Then we look at value all by itself. It's in an uptrend. Then we do ratios between the two, and this is showing how growth is still continuing to outperform value. We do an inverse of that same chart showing how value is underperforming growth. Then we look at a couple of different ways, long-term and short-term. Here's a growth to value index ratio going back a number of years, showing how growth is bouncing around a lot, but it is outperforming value. This shows how value is continuing to underperform growth. Then we look at some ETFs, also showing how value right now is outperforming growth. And then we look at another value to growth here, where value is underperforming growth. And then one last growth to value measure just shows again. So we're seeing confirmation when we look at different lengths of charts, different indexes, ETFs, we can say right now that growth is still outperforming value. And we look at a growth ETF and compare it with a value ETF. And even though it's been weak and we dropped down below the 250 period moving average, we've started to come back up. And we want to see this continue to go up if we're positive on the market. If things are turning more negative, we'll probably drop down below the rainbow. And we look at value versus growth, just an inverse of what we saw here, showing how value has been really doing well, but then pulling back into the rainbow lately. We look at the mid caps where they're bouncing back up a little bit, but mid cap growth of value has really been underperforming lately. And we look at small cap growth of value, also underperforming. If we see small caps and mid caps start to do better, we want to see growth outperforming value. This is the one I pay attention to the most. This is S&P growth of value. And even though it's coming back up and in a longer term uptrend, since the blue line's above the red line, we want to see this continue to go up if we're positive on the market. If things turn more negative, it's likely that this ratio will go down. And we keep an eye on inflation. Here's a monthly chart of the CRB index on top, and it's slightly above its moving average, but not really going up or down, where we look at a ratio between inflation and deflation down below, and we're actually below a declining moving average. So this is why the Fed was really willing to come in and cut rates 0.5% last week, is because inflation seems to be getting under control for right now. But we always want to keep an eye on that because things can change. We also look at the CRB index. This is a daily chart, or it's in a downtrend now. We've just recently seen a death cross here, but over the past few days, the CRB index has been doing quite well. Then we look at the Baltic Dry Index and compare it to the S&P 500. We're still going sideways here. And this is what does it cost to ship products from point A to point B in the Baltics. And when this is going up, that tends to be inflationary. When it's going down, that's more deflationary, but it's going sideways right now. Then we just want to keep an eye on other markets. Here again is the CRB index. We look at aluminum, which has been chopping around, and it's still kind of loosely in an uptrend right now. Wheat is in a downtrend, even though it's been bouncing back up. Corn is also in a downtrend, so these are more deflationary. We keep an eye on fertilizer, which is not really going up or down all that much right now. We watch oil. Now, we watch this for inflation, deflation purposes, but right now we're keeping an eye on it for geopolitical reasons. And it came back above 70, but it has been falling lately. Then we do a ratio between gold and oil, and gold has been doing well as oil's been going down. And so that's why we see this ratio going up. And we do another correlation between oil and the 10-year yield. And you can see there's a pretty strong relationship between the two. After being neutral, it's starting to get a little bit stronger now. So if you follow oil and you follow the 10-year yield, right now they're having a tendency to go in the same direction at the same time. And we keep an eye on gas, which is in a downtrend because it's an election year, so they want to bring prices down. Heating oil is also in a downtrend. That's more deflationary. Natural gas been chopping around here, still in a downtrend. We keep an eye on diesel, which has been going down. Now, this is the spot price. This means what is it right now instead of the futures price? What do they think it will be at some point in the future? Then we keep an eye on copper. This is a barometer of the economy where it's really been coming down, but now it looks like, okay, maybe the economy is not falling apart. So copper is trying to go back up here and may possibly try to get back in an uptrend. And we look at copper to gold and we do a ratio. When copper's underperforming, this ratio goes down, and it's been going down largely, and gold has been going up. So that's why we're seeing this ratio decline. And then we look at a longer term chart, and I also plot the 10-year yield and the 2-year yield, and they've been coming down. And we're also seeing this ratio coming down as well. And that tends to be more deflationary on the surface, but we want to keep an eye on gold because a lot of times gold will go up due to inflationary fears. And we look at the gold ETF, which set an all-time high on Friday. Silver is also in an uptrend, but not setting a new all-time high. Then we look at the closing price for gold, the closing price for silver, and we can see there's a pretty strong correlation between the two. And then we do a gold to silver ratio. When this is going up, gold is outperforming. When this is going down, silver is outperforming. And we can compare it to the dollar because there's a relationship between precious metals and currencies. And we see that it's a pretty strong relationship right now. So sometimes if you're more into these markets, you might want to look at this and see if the correlation is strong. The dollar's been going down. Well, is that going to put some pressure on the gold to silver ratio as well? We look at the dollar on a daily basis here. I also showed a weekly chart in the weekly video where it's in a downtrend, but we're still above the 100 level. This is a longer term look at a trend line where we're starting to break below this trend line that connects these previous highs. The euro, which is in an uptrend compared to the dollar, we show that here. And then we have the Japanese yen, which is now in an uptrend, but for a long time it was in a downtrend compared to the dollar. The euro's in an uptrend against the dollar, and the dollar is in a downtrend right now. This is breaking it out, looking at the euro to the dollar, where it's stronger than the dollar. And the Japanese yen just recently saw a golden cross where it had been in a downtrend compared to the dollar. And the British pound is also in an uptrend compared to the dollar. Then we're looking at the S&P weighted index versus the equal weight index, and we're not seeing a real disconnect right now. They're both moving more hand in hand. This is another way of looking at that. When this ratio is going down, that means the equal weight is underperforming. And earlier in 2023 and into 2024, everybody was complaining, saying, well, there's just a few stocks that are really driving the indexes higher. Well, that's what's happening when we see this ratio going down. Now we see the rest of the S&P performing better, and we're starting to see this ratio going back up. And we look at stocks, compare them to commodities, where stocks are outperforming. This is an inverse showing how commodities are underperforming stocks. We look at the NASDAQ 100 and compare it to the S&P 500. And the NASDAQ 100 has been underperforming now, and it has been for the last few months, where we're actually seeing a death cross here. Doesn't mean there's weakness in the NASDAQ 100. It just means that the rest of the S&P 500, which is a broader index, is actually holding up better right now. We're not getting all of our strength from the NASDAQ 100. The S&P 100 is actually in a downtrend compared to the rest of the S&P. And the NASDAQ, which is doing better than the NASDAQ 100 that I'll show here, we are getting ready to see a death cross here. And we want to be aware of this. Now, even though the NASDAQ's been doing well, it's been underperforming the S&P, which set an all-time high this past week. And we're waiting to see if a death cross happens with this ratio. Then the NASDAQ 100, as I mentioned, is underperforming the NASDAQ, but both have been doing really well in 2024. We look at the mega caps and compare them to the equal weight. Now, the mega caps were really going up, and this is what was really driving the market higher. You can compare it to the S&P up here. We're not seeing that now. So we're wondering, is the market becoming more defensive and getting ready for a decline? Or are we just seeing a more friendly environment for other stocks in the S&P for them to be able to go up? Small caps to the S&P 500, even though small caps have been bouncing up, Longer term, they're still underperforming the S&P. This is another look at the small cap to S&P ratio. That's the red line where more or less it's going down. The blue line is the S&P itself. We look at the big software companies, starting to see a little bit of strength there. The mega caps in a solid uptrend. They're above both of the moving averages, and all of the lines are going up now. Robotics and AI ETF. This is coming slightly out of the rainbow, but when we compare it to the tech sector, it's actually underperforming and going down below the rainbow. We look at the Dow Jones Composite Average, which is the Dow, the transports, and the utilities together. They're all doing quite well. The Dow setting a recent all-time high. The utilities are pretty strong. It's the transports that have been really lagging behind. The Wilshire 5000, a broad market measure, is coming off of just setting an all-time high on Thursday. And we just set an all-time high with the total U.S. stock ETF. So this is a very broad market measure. Low volatility stocks, they've been doing quite well. But they've been doing well in 2024. But when we compare them to the S&P, they've actually been underperforming, even though they did start to bounce back up. Now, if we do get set to go into a weak time for the market, this ratio will probably continue to go back up and possibly see a golden cross with this ratio. And we look at the advanced decline line. Even though we declined on Friday, we're still looking good with the NYSE common stock, the S&P, the mid caps, and the small caps. They're all above an advancing moving average. And here's the Dow just coming off of an all-time high on Friday, where the transports have been underperforming. The utilities have been doing well. They pulled back, but now they're still holding up for the most part. And here's another look at the transports, where they've just been chopping sideways in 2024. And they've been really underperforming the S&P on a ratio basis. And they've also been underperforming the Dow. When this ratio is going up, that means the Dow is outperforming the transports. And we look at the correlation between the S&P and the transports, and it's fairly strong, not as strong as it has been, but they're tending to go in the same basic direction. But you can see big decline in Friday's session. And this is a new idea behind Dow theory, where instead of using the Dow, we use the S&P, which is setting a new all-time high. And instead of using the transports, we use the NASDAQ, which has not set a new all-time high. So it's positive in that we're setting an all-time high with the S&P, but there's a negative divergence here because we have not set a high with the NASDAQ. Now, we break that out a little bit further, where instead of using the S&P, we use an equal weight version of the S&P, which is just coming off of an all-time high. And then we use an equal weight version of the NASDAQ 100, which is the QQQ equal weight ETF. This is not setting a new all-time high. The FANG index, even though we're seeing the 50-period moving average declining, price is above both lines, and that's positive. And we were able to get back above this longer-term trend line, but we're still below this shorter-term trend line here. We'll be watching that to see if it provides overhead resistance. ARC was down, and it's in a downtrend, just not really participating these days. We look at the all-world stocks, which takes out U.S. stocks, and they're doing quite well by themselves. And we compare them to U.S. stocks, where U.S. stocks are outperforming. When this ratio is going up, that means the SPY is outperforming world stocks. Then we look at a longer-term chart here. This is a monthly chart looking internationally at stocks, Europe, Australia, Asia, and the Far East. Longer term, U.S. stocks still continue to outperform. We are a little bit concerned here because the momentum oscillator is kind of going sideways, but you can barely see it, but it's starting to go back up. Then we look at bonds. This is the ETF for the 7 to 10-year bond ETF based on price, where it's in a solid uptrend right now. But if you look at this, we're still above 50 with the RSI. However, the momentum has shifted negative. We look at a total bond ETF, which is in a solid uptrend, and a world bond index here, which is also in an uptrend. These are bonds based on price, not yield. And we look at a monthly chart of stocks to bonds. Now, a week ago when I did this video, we'd come all the way down to the moving average. We're starting to show an improvement with stocks. And since this is a monthly chart, we have to have the end of the month before this chart completes. Then we look at corporate bonds here, which are in an uptrend. And we look at junk bonds here, which are high yield bonds. They're setting recent all-time highs. We look at a correlation between bonds and stocks, showing how bonds continue to underperform on a daily chart. So we see this here on a daily chart. In the weekly video, I show a weekly chart, and we just looked at a monthly chart where stocks are still outperforming on all time frames. Then we look at a ratio between riskier bonds or junk bonds and more conservative bonds. And we started to fall down below the rainbow, but now we're starting to go back up because maybe interest rates have topped out. And so folks have got into the more conservative bonds and they're going to ride those out. But in the meantime, they may get into the junk bonds because they give a higher yield, even though there's more risk associated with them. If we start to see more weakness and we're starting to see this rainbow begin to roll over, we'll just keep an eye on that to see if that ends up being more negative. We look at some fib levels here for the 10-year yield, but we're not close to any of those. This is a long-term chart of the 10-year yield showing how it's been coming down. And we look at a ratio between stocks and the 10-year yield showing how stocks are underperforming the 10-year yield. Here's a 30-year chart with fib retracements here, and we're not really getting all that close yet to this fib line. And we look at the correlation between stocks and bonds, and they're actually going down and possibly going neutral, where typically stock prices and bond prices will go either in the same or opposite directions. We're wondering if there's going to be a shift in the market because of this. Then we look at the S&P 500 compared to shorter term bonds, showing how stocks are outperforming. Then we look at the S&P 1500 and compare it with short-term bonds. So this shows the broad market's doing quite well compared to bonds. And we look at another broad market measure and also look at 3 to 7 year bonds a little further out, showing how stocks are outperforming. And we look at the tech sector to 3 to 7 year bonds, and this is a little bit of a concern. Even though we've been going back up and we're repairing some damage here, we have not come out of the rainbow yet. The tech sector is not showing the strength that it had been showing a few months ago. Then we look at a ratio between the 3 to 7 year bond and the S&P 500. When this is going down, that means stocks are outperforming. Back in July and into August, when the market was fearing that the economy was falling apart, we saw a real spike up here. And then this was the big down day that we saw August 5th. Well, then that looked better. Then it started to go back up. Now it's starting to go back down. If we start to decline with the S&P, we'll probably see this ratio going back up. Junk bonds also setting a new recent all-time high. And we look at a ratio between junk bonds and more conservative bonds, and we're starting to see this coming down. Junk bonds aren't outperforming the way they were. And we saw that in that other previous chart too with the rainbow. We look at corporate bonds, which are in a solid uptrend. And then we look at a weekly version of US, UK, Japanese, and German rates, where rates for the most part have been coming down. And we look at the volatility of bonds. This is the MOVE index, and the volatility of stocks, which is the VIX. And we see that there's a pretty high correlation between the two, as volatility has really been dropping. Now, this doesn't measure direction. This just measures the movement of volatility. And then here's a daily chart where we've really been coming down on the yields across the whole spectrum of maturities. But in Friday's session, they really bounced back up. And this is a monthly chart of the 30-year price for the ETF, where it's starting to finally go back into an uptrend after being in a long-term downtrend. And we look at a ratio between the 30-year bond and commodities, where bonds are outperforming, even though they had been in a long-term downtrend. Then I look at different sectors. First, we look at just the sector itself. These are materials, and it's in an uptrend. But when you compare it to the S&P, it's continuing to underperform. Communication is in an uptrend, but pretty much going sideways compared to the S&P. Financials, one of the stronger areas when you look at it by itself, and doing okay. Actually just saw a recent golden cross here with this ratio, and this is one of the stronger areas. We want the financials to do well if we're more positive on the market. If this really starts to fall apart like it did back in 2007 into 2008, that could really mean there's some trouble happening. We look at energy, which is in a sideways move here, but still in a downtrend by itself, but it continues to underperform the S&P. Industrials are in an uptrend and pretty much going sideways right now when compared to the S&P. The tech sector, which is still in an uptrend, but starting to underperform the S&P. And we've seen a recent death cross here with this ratio. Staples, toilet paper, toothpaste. This is in an uptrend when we look at it by itself. And sometimes I show this in the daily videos. And starting to see a golden cross here when we compare it to the S&P. That could mean that the market is getting ready to be more defensive. We just want to keep an eye on that. Real estate, which has been doing really well since interest rates were, now they've gone down, but With the Fed cutting rates, the real estate sector really likes that. And they're starting to show some good performance here compared to the S&P. We've seen a recent golden cross with this ratio. Utilities just been going crazy lately and doing really well and actually outperforming the S&P. And then we do an S&P to utilities ratio. When this is going up, that means the S&P is outperforming. When this is going down, that means utilities are outperforming. If we're more positive on the market, we want this ratio to go up. If we're more negative, this ratio will go down. This is currently going down right now, so we're a little bit concerned about that. Healthcare, another defensive area, looking good all by itself and showing some improvement here, but pretty much it looked like it was breaking out, but it pretty much has dropped down below the moving averages over the last few days. Discretionary, this is like a growth area. Tesla's in this area here. It's in an uptrend by itself, but it's continuing to underperform the S&P, although it's coming back up close to this 200-day moving average with the ratio. We look at another ratio of the energy sector to the tech sector, and energy's been doing weaker, even though tech hasn't been doing as strong, but energy's been doing even worse according to this ratio. We look at growth stocks and compare them with bonds, pulling back as the market became more defensive, now starting to improve. And we look at the tech sector to the 10-year yield, where the tech sector is still outperforming the 10-year yield here. And then we do an inverse, showing how the 10-year yield is underperforming the tech sector. Discretionary to staples, we want this to do better, and it's been improving, but it's in a downtrend longer term. If we're more positive, we want this ratio to continue to go up. And then staples have been outperforming discretionary, but lately have been underperforming. Gold to the S&P pretty much going sideways. Both have been doing quite well. Gold is breaking out, and the S&P set an all-time high this past week. And the dollar's been going down, and gold has been going up, so we're seeing this ratio really breaking out here. The NYSE coming off of an all-time high. High leverage loans doing quite well, meaning that the economy should still hang in there for the time being. And all stocks are in an uptrend coming off of an all-time high. Semiconductors kind of not performing as good, coming back down to their 200-day moving average. And we're potentially seeing a death cross here with this sector. So we want to keep an eye on this one. Emerging markets are in an uptrend. And we look at the micro caps, which are also in an uptrend. The Japanese Nikkei, it's not at its all-time high, but it seems to be doing better. This big dip down, that was August 5th. That's when the world freaked out for a couple of days. And Bitcoin is in a downtrend, but it's been bouncing back up to its 200-day moving average. And we do a study of the home builders. And right now, we're not really getting much from this chart because the correlation between the home builders ETF and the S&P 500 is really quite strong right now. Here's an intermarket analysis chart going back to the beginning of 2024, where we have gold, and then stocks, and then oil, and then the dollar, and then bonds. So all of these indexes are positive year to date, where bonds have been negative for much of 2024 based on price. And we're starting to turn back up with a long-term oscillator, the KST, in China, turning back up a little bit with the emerging markets, turning up but still negative in Europe, it's trying to roll up in Japan, and trying to turn back up in the US. Then we look at some correlations where we look at the S&P to the dollar, and they're having a real strong tendency to go in opposite directions right now. S&P to oil, they're having a tendency to go in the same direction right now. S&P to the 10-year yield, a slight tendency, just coming out of being neutral, but a slight tendency to go in the same direction. And the S&P to the 2-year yield, a pretty strong tendency to go in opposite directions. And the 10-year yield to tech, they're neutral right now. And then we look at some long-term charts. This is a monthly chart of the NYSE above an advancing moving average. That's positive. And the long-term oscillator, which is the Copic curve, is also positive. And this is a daily chart where we're looking good with the NYSE, and the record high percent index is also going up. And the NYSE is just coming off of setting an all-time high. This is a monthly chart of the S&P. We're still above the moving average. And we're rolling over a little bit here with the percentage price oscillator, but this is still looking positive for the time being. And then here is a daily chart of the S&P, and then a ratio between stocks and commodities showing how stocks are outperforming. Then here's a monthly chart again of the NYSE up here, which is doing quite well and also in an uptrend. And then we look at the S&P with the global index here, showing how US stocks are outperforming, but we're still fairly flat with the KST, which is a momentum oscillator. And then at the very end, I do a list of all those things that are positive. My definition of positive is when the 50-day moving average is above the 200-day moving average. So when we look at growth and value by itself, they're positive. When we look at copper, it's still positive. The British pound and the euro compared to the dollar are positive. The Japanese yen to the US dollar is positive. Gold and silver are positive. The big software companies, the mega caps, the FANG index, the low volatility ETF, staples are positive. The Dow Jones Composite average is positive. And then all the different bonds that we follow based on price are positive. The tech sector and semiconductors are positive, even though they've been pulling back. High leverage loans, we're watching that more to see what's going on with the economy. The Dow is positive. The NYSE Composite and Wilshire are positive. The NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps are all positive. All stocks are positive and emerging markets are positive. And I have this asterisk here to tell me that's the end of the list. Now we go to the negative side. And my definition is when the 50-day simple moving average is below the 200-day simple moving average. The CRB index is still in a downtrend, as is the dollar index, ARK, and Bitcoin are all in downtrends currently. Thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. Have a great weekend, and I will talk to you in the next video.